Today I'm going to be getting into one of the other asset classes that I really haven't talked about specifically in these videos, and that's commodities. So commodities are physical things. Things like oil or wheat or gold. There are quite a lot of things that will fall into the category of commodities. Quite often these things are inputs in the creation of other goods, and their own prices will change as economic and market conditions change, so they can be traded on their own outside of the actual end goods that they're used for. Now, commodity prices are discussed quite often as they're very important for an overall economy. So as a first video in this series on commodities, I'm going to give a general overview of how the broad market for commodities works. So many different goods fall into the broad category of commodity, one of them being energy goods. And this would be things like oil, coal, natural gas. And this is really significant in economic considerations, as more economic activity requires more energy input. And since the economy as a whole is so dependent on things like oil and gas or coal, changes in price of these energy commodities can have enormous implications across the entire economy, going beyond individual sectors. Base metals are another really key fundamental economic input. These are things like tin, copper, iron, and aluminum, and also aluminium. Base metals are those real fundamental input metals that would be used to build structures or make wires, things that are at the most fundamental base level of infrastructure and products. Precious metals are those metals like gold and silver. They're very often bought and traded as stores of value, but are also used decoratively or for luxury goods and art. Agriculture includes things like wheat, fruit, soybeans, coffee beans, and these fall into the broad category of softs. Softs are commodities that are grown, and this can include livestock as well, as opposed to being mined like metals are. Now, on account of humans need to eat stuff to be not dead, agricultural prices are of enormous significance to every economy and society in the world. And there are plenty of other types of commodities as well, things like wood, livestock, as I mentioned earlier, and people have sometimes considered things like carbon credits to be commodities as well. There are a lot of different ways that commodities can be bought, sold, traded, and invested in. And these can include very direct methods and some very indirect methods. The most straightforward way is to just buy a commodity outright. Just go buy gold, buy silver, buy barrels of oil, buy corn. This would be just having the commodity itself. Commodity indexes, commodity funds, these are also a way to gain exposure, and there are many different forms that this comes in. It could be a fund that owns commodity futures, a fund that is a share of a trust that stores that commodity itself, like a trust that holds physical gold, or it could be one that tracks a commodity index. There are public and private versions of these, and funds like this aren't limited to just one commodity either. There are funds that hold many different commodities. There could be a fund that tracks all different grains, for example, or one that is a very broad basket across energy, agriculture, metals, woods, all sorts of things. The way commodities are most frequently traded, however, are with commodity futures. Commodity futures exist across a wide range of different commodities, and when dealing with commodity futures, there are other elements to them beyond just the price of the commodity itself. And this introduces roll strategies, which is something I'll talk more about in the video. Commodity stocks come in different forms. This could be a share of a trust of a commodity itself, which gives very direct exposure to that underlying commodity. But there are also companies that are very highly influenced by commodity prices. Something like this would be a copper mining company, where the investor owns a share of a copper mine, and even though the copper mine's shares won't change directly with the price of copper itself, since that is its core business, the value of the company is going to be heavily influenced by the price of copper. Another common way people gain exposure to commodities is through the use of options. This could be options on futures, could be options on commodity index funds, on trusts, on commodity exposed businesses. Even though there are some different strategies and considerations that investors often have when trading options on commodities and commodity-related securities and derivatives, I'm not going to go into anything beyond what was in the options video in this one, except just to point out that this is also a common way that investors gain exposure to commodities. Now, since commodities are so fundamental to any economy, very often they're invested in or traded in order to take an economic position. One very common way that this is done is that frequently commodities are viewed as an inflation hedge. Since inflation can be thought of as a rise in general price level or a devaluation of the currency of an economy relative to assets, and commodities are the most fundamental building blocks of a whole economy, the idea is that the core commodities themselves will hold their value. So even if actual purchasing power doesn't increase by investing in commodities during inflation, it will at least preserve purchasing power. At least the hope goes. And since they're so fundamental, they can also be traded as a stance on the economy itself. For example, if an investor believes that industrial activity is going to ramp up, then that investor might think, well, then the businesses are going to need more energy in order to get that done. And that could lead an investor to think, well, therefore, energy prices are likely to increase. Then perhaps that investor might invest in oil. Very often, there's also a hedging element on the side of the producers of a good. Imagine a soy farmer. That farmer has a suspicion that prices of soybeans might go down over the next year. So what that farmer might do is sell soybean futures, so that the farmer now has a contract to be able to sell the soybeans at that price, regardless of where the market ends up going. Similarly, a business that needs to buy soybeans, expecting a price increase in the future, might buy soybean futures, so that there is already a contractual locked-in price that that company will be able to buy at, regardless of where prices end up going. So as I've mentioned, commodity futures are one of the most frequently used methods of gaining exposure to commodities. So there are two sides in a commodities future contract: the buyer who is long the contract and the seller who is short the contract. Since a futures contract is an agreement between these two parties to trade a good at a given future date, the buyer of the futures contract, who has agreed to buy that commodity at the settlement date at the settlement price, will profit as the price of a commodity rises up above that settlement price, since that buyer will now be buying something at a price below where it is in the market. And as the price of the commodity rises, the seller of the contract, who now has to sell the commodity below where it is in the market, will experience a loss. The buyer who is long the futures contract will gain when the price of the commodity rises and will lose when the price of the commodity falls. Conversely, the seller who is short the contract will gain as the price of the commodity falls and will lose as the price of the commodity rises. In practice, however, commodity futures traders don't typically wait for settlement to end their position. Generally, they will buy an offsetting contract before settlement so that they are now in a neutral position. This would be if someone who's long grain futures sold an equivalent offsetting short futures position. So now they're neither long nor short, effectively closing out their position. It's also very common today for futures contracts not to be settled with an actual exchange of the physical commodity at settlement, and instead they are cash settled. So that difference in price that would have occurred if the actual exchange were made, that much is exchanged between the long and short parties of the contract as if it had happened. Going further, today it's very common for futures to be marked to market, where the long and short end put in an initial margin amount, and every day that change in price from the underlying is reflected in their position, effectively moving the values of the accounts every single day to line up with the change in the value of that futures contract. And generally, we can expect the price of a commodities future contract to equal the spot price of the commodity today, as if you were to go out and buy that much of the commodity right now, physically. Then we multiply that by that time value that we discussed in earlier videos, that future value we get by multiplying it for the period of time by the risk-free rate. So we have the spot price moved forward with a time value into the future, that risk-free rate for however long the contract is, then we add on to that a storage cost. Now, a storage cost is because physical commodities might require expenses to be able to store them. Say there's some grain that can spoil if they aren't in the right conditions. So the costs incurred by storing a commodity for that period of time is reflected in that price, where the buyer of the futures contract pays for it in a higher futures price. However, there may be a convenience yield as well. Some gain from holding the commodity itself, the inverse of a storage cost, something that is gained by having possession of it. So we can subtract that, since the buyer does not get that benefit because the buyer holds the futures and doesn't hold the actual commodity itself. Now keep in mind this is a very approximate and theoretic way of thinking about what a commodity futures price is made up of. This does not include everything that can be a part of the market, but can be a good general way of approximating what goes into commodity futures contracts. One thing I just want to go through before I get to the last section, there are a couple terms that are very significant in futures. If you were to plot out the different settlement dates of futures contracts, you have the one that is the closest, say 1 month from now, and then you plot out the price. What's the price 2 months out? The price of 6 months out, the price of a year out. And you find that the price that you plot is arcing upward, then this market is said to be in contango. If you were to plot out the futures of different settlements and find that the shape you made slopes downward, however, then this would be said to be in backwardation. Contango slopes upward, and backwardation slopes downward. So what makes up the return on a futures position? Well, we're here. Roll yield. So the roll is the difference in price between the spot price and a futures contract, or between a futures contract and the futures contract that's further out than it. Say, the difference between the price of a 1 month futures versus a 2 month futures. And the idea is that if there's a convenience yield large enough to put the futures price below the spot price, then the futures price generally rolls up to the spot at expiration because it's no longer in the future. It's now a present contract. If an investor has a short-term contract and rolls that to a longer-term contract, closing it out and entering into one that is of a longer term, and the investor's in a backwardated market where prices of further and further out contracts arc down over time, then as time to settlement decreases, rolling that position is expected to give a positive roll yield. So as that convergence happens in a backwardated market where that graph of prices arcs downward, rolling the futures contract will gain a positive yield for the investor who is long a futures contract. Now if the market's in contango, on the other hand, where it's arcing upward, then we expect to see a negative roll yield for the investor. These contracts are rolled as the time to settlement decreases. Say you had a 1 month futures contract, well now as it's just a few days out approaching expiration, rolling that to a new 1 month contract. Another source of return in futures is the collateral yield. Since when initially entering into the futures contract there's margin put up, some of that money is going to be earning a yield, the money that's put up as collateral. That will generally most likely be getting a cash return, so any return that is gained on the collateral goes into the overall return on the position. And last, and perhaps most fundamentally, is the change in the spot price of the underlying commodity itself. It goes back to that idea of the price of the commodity goes up and you're long a future, you gain, it goes down, you lose. Well, I hope this episode has been helpful, and do subscribe if you enjoyed it. And until the next one, have a nifty day.